Okay, welcome back to video number 10. If you recall, in video number 9, we were getting perspective on global GDP, and in particular, United States GDP. And our view on global GDP, we discovered, is really going to dictate our positioning in our portfolio for indexes like the S&P 500, the FTSE 100. But it also dictates our positioning not only in indexes within the stock market, but also within currencies, commodities, and interest rates or bonds. Now, we're going to move on to actually predicting GDP. And given that the United States GDP is the most important by far, we are going to start looking at what we call leading indicators that predict GDP in the United States in the future. Now, your job as a trader really is to predict the future. You want to be in a situation where you're using the market now as a proxy for your expectations in the future. And this is what professional traders do. The first thing we're going to do is define what a leading indicator is, and then we're going to move on to the most important one, which is the ISM, the Institute for Supply Management Report on Business, sometimes called the PMI, the Purchasing Managers Index. Now, the ISM is very, very important, and it's also extremely useful not just for predicting GDP, but also for deciding what to buy and sell within the manufacturing industry. Because we get some qualitative clues from the ISM every month that tells us which industries are growing the most and which industries are contracting. Therefore, we can get clues of which way to be positioned. So it really tells us two things. It tells us the expectation of GDP in the United States in the future, but for now, therefore we can use the index to represent our view at this stage for a prediction of GDP in the future. But also in the qualitative statements, we can also use the ISM to discover what we can actually go out and buy and short within our portfolio and within the United States. Now, the ISM is widely, even by professional traders, it's widely misunderstood and misinterpreted. If you do a bit of work and do a bit of digging, you'll realize that historically the ISM is extremely important and an incredible indicator for predicting GDP and deciding what to buy and short. So without further ado, why don't we go over to the presentation, and I'll see you at the end of the video with a summary. So how do we predict GDP? Leading indicators. Lagging indicator tells you what's happened in the past. Coincident tells you what's happening right now. Leading tells you what's going to happen in the future. There's only two things that make up an economy: businesses and consumers, the private sector. Well, there's the private and the public sector, but the private sector is made up businesses and consumers. And within businesses, there's just two different types: manufacturing and services. And within both, you've got cyclicals and defensives. What we're going to look at first is leading indicators that tell us what's going to happen in the manufacturing industry. First one, Institute for Supply Management, ISM, Manufacturing Report on Business or Purchasing Managers Index. It's a well-known indicator in the US, but people don't use it enough, and there's tons of information in there for you to make money. Gets released on the first business day of each month, and the URL is there, so you can even just Google it, you'll find it straight away. Essentially, what is it? A survey of 300 US manufacturing companies in the US, and it's related to their business activity in the previous month, covering 5 areas. Represents 20% of the US economy, so why do we look at it? Because the other 80% is services. So why do we look at manufacturing first? Why do we place a bit more importance on it? You can guess. Well, you get more data because services only goes back to the late 70s. So you get more significance over more business cycles. So we're going to look at an ISM report from a few years ago. We're going to look at the ISM report of September 2010. And at this time, QE measures have been announced in the United States for QE2. And they were starting to actually print money in September. So it was announced in May to start in September. The survey is equally weighted across 5 areas. So the purchasing managers at each of the manufacturing companies is asked a series of questions on the 5 areas that you're looking at now. So in the last month, what are you seeing in new orders, up or down? Production, is it up or down? Are you planning on hiring more people in the future? Deliveries, up or down? And inventories, up or down? Now, if you've got a warehouse full of widgets, if you're really, really bullish on the future, what do? You fill your warehouse full of more widgets. If you're really, really bearish on the future, what do? You destock. You try to get all of your stock out the door, so you've got an empty warehouse. That's just the basics of inventories. So let's have a look at what it looks like when it comes out, and how you actually interpret it, and how you trade off the back of it. The headline number is reported there, the PMI, 54.4. Remember, this is September 2010. Basically, if the headline number, every number that you're looking at is a percentage number. If it's above 50%, it means it's growing. If it's under 50%, it means it's contracting. So growing on the previous month, contracting on the previous month. Yeah? So what does that tell us? Well, the PMI, the headline number is 54.4. And in the previous month, it was 56.3. So 1.9% change. It's growing because it's reported to be above 50, which means it's growing. But it's growing at a slower rate. And we've had 14 months of the trend, which is growing. So 14 months above 50. Make sense? So take 14 months off September 2010, what do we get to? Sorry?
July 2009.
July 2009. What do we know about that time period? When did the US come out of a bear market? December 2010. So this started telling you 18 months before that the US was going to come out of a bear market. Because the manufacturing industries were reporting growth for the first time, 14 months previous to that. It's pretty significant. So what would have happened if you'd have bought the market, the stock market in July 2009? When you saw this for the first time go above 50. Because the months previous to that, there was a year of reporting of contraction. So what level would you have bought the stock market at in July 2009?
What?
Let's go back to the charts. Let's have a look. There. That's just you saying the ISM is growing for the first time. in months and months and months. So the US manufacturing industry has just started reporting some growth for the first time in over a year. Well, longer. It was over 2 years. So you just go, I'm buying the S&P 500. Is it hard? So what would you have bought it at? You'd have bought it at 900. And what do you think stocks that were part of that index, some of them would have outperformed, and some of them would have underperformed. So some stocks, so the stock market goes from 900 to, let's say, 1200, 300 points. There'll be some stocks that tripled. Just that one indicator. Incidentally, let's have a look at this again. Where did the stock market bottom? Anybody know what that was there? It's quite well known. The trading low of the S&P 500 was 666 in the first week of March 09. Now let's connect the dots here before we even look at the ISM. What do we think the bottom of the ISM was? The bottom of the ISM was February 09. And then when it was reported on the first business day of March 09, the March number, it contracted at a slower rate for the first time. And then the market bottomed. Because everybody bought their shorts back, saying, okay, the business cycle has now bottomed. That was it. That was the bottom of the market, March 09. And you get all of the other, you can see the contributions of the different parts of the ISM. So how much is new orders contributing? How much is production contributing? You start to learn what's going on. You learn what's going on in the US economy when you look at every report. That's what it looks like, going back to 1947. And when you look at the ISM, what you're actually looking at there is the business cycle of the United States. What do you think will happen if we put on the right-hand axis GDP growth in percentage terms going back to 1947? What would it look like?
Same, just lag.
Same but with a lag. So we zoom in a little bit there. Actually, I think we do 1972. So we do the last 40 odd years. That's the ISM on the right-hand axis and percentage real GDP growth in the United States, year on year. It's the business cycle. ISM against GDP 1972. So what happens? The ISM when the ISM goes down, 12 months later the GDP number is contracted. When the ISM goes up, 12 months later GDP numbers reported as expanding. So by the time GDP is out, it's old news. It's irrelevant. Because the market has moved and you've participated in the move and made money. It's a very powerful indicator for actually representing your view on the world and then using indices, commodities, currencies and rates to express that view. If you do it like that and nothing else, and you write between 67% and 93% of the time, you're going to be very wealthy in your life. And I know the guys that came last time when we did the interview here, I try not to measure anything relative, but so in absolute terms, you should make money all the time if you do that. And you don't even have to trade every day. You can trade once a month. You can trade once a quarter. Just buy the S&P 500 for the next 6 months. Just leave it, if that's what you think. Yeah? That's fine. If you make money, you make money. But if you do it in up markets and down markets, where you're going long and short, and you do it for the rest of your life, you're going to make more money than everyone else. So over time, you're going to get relatively wealthier to everybody else in the world. Because what happens to all the fools that have pensions? When the stock market halves, their pension halves. But what do? You double your money. So you get 4 times wealthier. You get 4 times wealthier in a recession. So when the ISM is above 50, it's basically saying 12 months from now, the US economy will be growing. Whether it's at a slower pace, that's fine. You know, you find that out at the time. But if it's just above 50, in a year, it's growing. Therefore, S&P 500 returns are likely to be positive, more than likely. So you're basically predicting the 1-on-1 situation. You're buying the market now in anticipation of, say, a 20% move up in the stock market in the next 12 months. That's why you're doing it now. Because if you don't, but if you do when GDP comes out, you've missed the opportunity. When it goes below 50, the US economy is contracting, and S&P 500 returns are likely to be negative in the next 12 months. So you're trying to predict the 0-0 situation. S&P 500 falls and GDP falls in the next year. And when the ISM peaks, what does it mean when it peaks and troughs? Well, let's have a look at the chart. When the ISM peaks, we're trying to predict the 0-1 situation. That's a peak, that's a peak, that's a peak. That's a trough, that's a trough, that's a trough. So when it peaks, you're trying to predict the 0-1, where the expectations of the market have become too high in the short term, because the reality is that the economy is forecasted to grow, therefore S&P 500 should go up, but maybe not by as much as everybody previously thought. So you take profits. Make sense? It's not rocket science. I'm not from NASA. So how to follow the ISM? If it's above 50 and growing, you've got a strong bias towards being long the stock market. If it's above 50 and slowing, you've got a weak bias to be long, and there's nothing wrong with being market neutral or flat. You don't have to participate. ISM below 50 and slowing, you've got a strong bias for being short. ISM below 50 and growing, you've got a weak bias for being short, and there's nothing wrong with being market neutral or flat. You do not have to participate. One negative about professional traders is that they always feel that they have to participate. Retail traders, you don't. Professional traders have pressure from the external shareholders of the bank to hit targets every 3 months, so the bank makes money in their earnings and beats the previous quarter. You don't have to do that. Hedge fund investors put pressure on the hedge fund manager to outperform and hedge against inflation all the time, so they always have to participate. As a retail trader, you don't have to. So you're actually in a luxurious position where you can be long for 3 years, and then when the ISM peaks, you just say, do you know what? Can't be bothered. Just trade out of everything. Take the money you've made in the last 3 years, go live on a beach for a year and come back when the ISM bottoms out again. It's perfect. Retail traders have fantastic freedom. That's why I enjoy what I do so much, because I can leave and just go on holiday for 50 days if I want. ISM peaks above 50. Short, so slowing for the first time in a long time. So that peak, yeah? Short with a weak bias, market neutral or flat. Go to the beach. ISM troughs below 50, so growing for the first time. Sorry, not growing, slowing, the contraction slowing down. Long with a weak bias, but you can also be market neutral or flat. So when do you get strong biases? When it's above 50 and growing, when it's below 50 and contracting. That's very strong bias, yeah? All the stuff in between, you don't have to participate, but you'll have a weaker bias to be either way, yeah? But when you get hold of the notes, this goes, this is the last 13 years, well, 12 years. And it's just charting what you probably were thinking at the time. So there's no rule book where it says, where you say you have to do this at every level of the ISM. But what it does do is map out a thought process of what you should probably be thinking of doing when you see the ISM doing certain things. Like lessons that we've learned from the last decade and lessons from 1947 to present day. So just mapping those thought processes of how you input the decision-making process into your portfolio. But this is just one indicator. So it's reported monthly. We obviously don't get an update every day. But throughout the month, there'll be lots of indicators that will give us updates. Some of them will be lagging, some of them will be coincident, some of them will be leading. Lagging indicators, we've got no interest in. They tell you what happened in the past, and they confirm or deny what you were thinking months before. Coincident indicators tell you what's happening now, and they confirm or deny what you were thinking months before. So the headline in the FT, UK enters recession, that might be out in a few weeks' time. Is that useful to us? Complete nonsense. UK enters recession as a headline doesn't do anything for you as a trader. Doesn't predict anything, it just reports the news. What happened yesterday. What's probably happening at that time is that things might be turning and people are predicting that in 12 months' time the UK could grow at 2.5%. So everyone's buying the market and the market's ripping. It's completely irrelevant. And then all the retail traders come in and short on that headline and get carried out. If you go through, do a statistical correlation of the ISM with a time lag of 12 months, ISM is 85% correlated to GDP with a 12-month time lag since 1947. So even though it's now only 20% of the economy of the United States, it's still incredibly predictive of what's going to happen in 12 months' time. So you can't discount it. It's got significance over many, many business cycles. So we use it as an indicator to tell us what's going to happen in the US economy 12 months from now with 85% certainty. And we use the S&P 500 as a discounting mechanism to express our view. And we do it now. And when you're running a portfolio, you want to be switching your long-short bias and your worldview. You switch your long-short bias based on your worldview, and your worldview comes predominantly from all of your leading indicators. And the ISM is one of them, and it's one very important one. Because it's so predictive of what's going to happen, sometimes one measure or one read isn't enough, because you might be too early to a move. And you might actually, if you go in too early, you might actually be wrong for a month or two. So it's quite good to get into the habit of waiting for 3 or 4 readings to confirm what's going to happen. That's when you look at it against S&P 500 percentage returns on an annual basis. Pretty much exactly the same thing. The new orders part of the ISM is generally seen by professional traders as a leading indicator to the ISM itself. Because it's the most sensitive part of the report. So that's new orders against ISM, production against ISM, employment against ISM, deliveries against ISM, inventories against ISM. But what's great about the report is you also get a qualitative statement. So every month they pull out a bunch of comments that come from the purchasing managers of the companies themselves. And they also tell you which industries within the ISM are growing the fastest, reporting the most growth, in order to the ones that are reporting the least growth. And you can take clues from the report to generate trading ideas very, very quickly. So remember, this was in September 2010. Well, let's have a look at the report. 18 manufacturing industries, 13 are reporting growth in September. What does that tell you straight away? The majority of them are reporting growth. That's bullish for GDP in the future. In what order though? What's the industry that's reporting the most growth? Apparel. What's the industry that's reporting the fastest slowdown? Wood products. So what essentially is the apparel industry? It's consumer discretionary spending. So non-essential items. So clothing, but mostly medium and higher end retailers. Yeah, apparel. And what's wood products in the US? It's the timber industry for the construction industry for the US. Housing. What do you think would have happened if you have gone long the US apparel sector in on September the 2nd, 2010, and short the wood products sector, as in the US house builders, in September 2010? You just put that trade on for 3 months, 6 months. You'd have made money. In fact, you would have outperformed. What about the statements here from respondents? So, business results, top and bottom line, continue to meet or exceed our operating plan and exceed prior year performance by double digits. That's coming from the chemical products industry. So that's a guy who's the purchasing manager at a chemical products company in the US. What's that person actually saying in that statement? Read between the lines. Shall I translate it for you? From corporate speak into trader speak. Hi guys. The earnings estimates that we gave you 3 months ago, we're going to beat them because our operating plan is beating the plan that we gave you and we believed was correct 3 months ago. Oh, by the way, we're reporting in December and it's September, so you should buy my stock now before I report earnings going up. You'd have basically made a net return of 74% in 8 months. Not bad. No insider information required. And why did they go up? Why did you make 74% on that trade? Because the earnings of Ralph Lauren went up because GDP was going up, and it's a cyclical stock, consumer discretionary. And PHM, Holt, the earnings were going sideways or lower and they couldn't compete in the housing market as a house builder with all of the inventory that was on the market, i.e. developing houses, when all the subprime houses had been repossessed and they were being unwound into the repossession market. That's why. But what they were telling you was here, we're the manufacturing sector that's slowing the fastest relative to everybody else. They were telling you that there. All you have to do is connect the dots. Why are they slowing? Oh, I see. Foreclosures. Simple. Long Ralph Lauren, short pulled homes. 74% in 8 months. Can literally be that straightforward. In terms of rates and spending, the ISM is used as a significant indicator by the US Treasury to decide fiscal spending and by the Federal Reserve to set interest rates. If the Federal Reserve and the US Treasury expect GDP to contract, they reduce rates now. So what else could you have done here? When you're seeing this, Ralph Lauren, long, short, hold homes. And what's happening? The US Federal Reserve is spanking and reducing interest rates to zero. So quick recap. It's useful in 3 ways. Predicting US GDP to gain a world view. So you can actually have an overall view on the world. But it's obviously sensible to go and have a look at the leading indicators and apply the same thesis to Eurozone and to China. And you can. So you can work out in its entirety what the world's going to do. But the ISM's the most important one because it's predicting the biggest economy. In 10 years' time, that might be different. It might be China PMI. China PMI is pretty significant now. Secondly, for predicting stock market returns and for predicting business trends in a particular manufacturing sector. So what it actually does is when we go on to the next level tomorrow, which is industry view, it's one of the places where you can start to gain industry views on particular manufacturing sectors, to start generating ideas. Why is wood products slowing the most? And then you go and find out, and you form a view on the industry. So we got 4 spreadsheets in terms of downloads that we'll send you. So the stuff that you saw there with the Excel charts, these. I can send you the ISM Manufacturing Index, all the data, going back to 1947 with all the charts. ISM versus GDP growth, going back to 1947. ISM versus percentage returns of the S&P 500, going back to 1947. And a historical data master summary, which if you fill out each month, so you just have to clear content and fill it out, it tells you what's going to happen. It's really easy to use. Okay, so welcome back. I hope you managed to follow the presentation there and get a real insight into why the ISM is so important. And I think we've figured out here that the ISM is very important in 2 specific ways. Firstly, for predicting US GDP, and therefore the potential for global GDP because of the size of the United States. And if the ISM is very, very good at predicting GDP, then we're using the S&P 500 as a proxy now. Now, the reason why the S&P 500, as you saw in previous videos, predicts GDP with that time lag of 3 to 6 months is because the ISM is predicting GDP with a time lag of about 12 months, with an 85% correlation throughout business cycles going back to 1947. And professional traders are using leading indicators like the ISM to take positions now and then the S&P 500 moves, and it moves to predict GDP later down the line, so 6 to 12 months. So that's the first thing. The ISM is very, very useful in that way for our positioning in our portfolio and our world view, our global view. The second thing that's important about the ISM is the qualitative statements that we get from the companies themselves. Now, looking through the example that we saw, we can see that in the September report in 2010, that the apparel companies and the wood products companies were giving us clues as to trade ideas that could occur within our portfolio. And that example was a very good example of going long a US apparel company and short a home builder. Because what that's actually doing is predicting the earnings of the companies. The purchasing managers of those companies are specifically telling you in those statements what their earnings are going to be. So the expectations of the market shift. And what happens is professional traders will go long the apparel company now and short the home builder now, and then once the earnings come out 3, 6 and 9 months down the line, and those statements have occurred within the material change in the earnings, by the time this is news, the professional trader has made their money because the stocks have already moved. And what happens later? Well, the retail trader or the uneducated trader comes into the market and provides liquidity on the other side for the professional traders to get at. So I think you're starting to get an appreciation now of the bigger picture and why it's so important to use leading indicators to not only predict GDP, but also to potentially predict our positioning and our positioning in specific sectors and specific stocks. So the ISM comes out every month and you should diligently go through it and really understand and interpret what it means. And now you've got all the downloads. You can see from the downloads in video 9 and 10 that from the GDP numbers and from the S&P 500 correlation and from the ISM correlation with the stock market and GDP, that the ISM absolutely does predict GDP and therefore stock market returns. And it does this with an 85% correlation throughout business cycles since 1947. Now, it wouldn't be prudent as a professional trader only to rely on one indicator. I'm not advocating that at all. You should absolutely back up or look at other leading indicators throughout each month and always question your worldview. So the ISM and other indicators in their entirety are going to give you a very good idea, a very clear picture of US GDP 12 months from now, but you definitely shouldn't be relying on one. You should absolutely be relying on others as well. So if you bring them all into their entirety, then you're going to get a much clearer picture and the reliability of your analysis is going to be far greater. Now, the other thing we saw with the ISM was positioning. And again, I'm going to keep going back to this point. Unfortunately, there is no rule book. The market in 1986 is different to the market now. And the market in 2030 is going to be different to the market now. So when you're looking at the ISM and saying, well, I'm going to go long, short, or be market neutral in my portfolio, unfortunately, again, there is no rule book where you go onto Amazon or go to a bookstore and it says, if the ISM does this, you should be doing this. All history tells us is that there's an 85% correlation with a 12-month time lag. You can still have the right idea, but mistime the situation. So at the moment, we're going through the idea generation phase. And what I'd like to introduce to you now is this concept of an idea being an idea and not a trade. So this comes later, because after the idea generation process, we have what we call gatekeeping. And gatekeeping is basically putting up a barrier between your ideas and your real capital. And what we do in gatekeeping is basically cleanse our ideas. We basically take our ideas and say, well, there's a good idea, I think it's a good idea, but I'm not going to put the trade on yet because I need to time this correctly. Now, one of the worst situations as a trader is to have an idea, put it on immediately, lose money because you get stopped out on the trade, where you're losing too much money and you have to cut the position, and then later you're proved correct. So an example of that would be buying a stock at 100 because you think GDP is going to go up, the earnings of the company are going to go up in the future, and then you get stopped out or you have to cut the position at 90. And then the stock goes to 500. So what gatekeeping does is it stops good ideas being mistimed. And if you have a bad idea, you know what? A bad idea is just a bad idea. So that's where risk management comes in. So this concept of an idea just being an idea and not yet a trade is very, very important. Because when you're looking at stuff like the ISM, you shouldn't automatically just say, well, the ISM's above 50, so I'm going to initiate and buy the market now. You still need to go through the stage of gatekeeping and go through the stage and have risk management and have prudent risk management overlaid onto your strategy. At the moment, what we're doing is building our worldview. And building our worldview means looking at all of the economic indicators across the United States, Eurozone, and China. Now, we're not just going to rely on the ISM, we're going to move on now to our next leading indicator, which is within the consumer sector, which is the University of Michigan Consumer Sentiment Indicator. As you saw in the presentation just earlier, you saw that an economy is essentially made up of two things, businesses and consumers. Now, when we move on to consumers, we're going to look at consumer behavior and why consumer behavior is so important. The economy is made up of businesses and consumers, and you've already seen the ISM. There is one more indicator that I want to show you before we go on to consumers though. It's the ISM services sector, because the ISM services index doesn't represent manufacturing companies, it represents the service sector within the United States, which makes up 80% of the US economy. Now, why do we not place as much importance on ISM services as the ISM? Well, for two reasons. One, because the ISM data goes back to 1947, and the ISM services data only goes back to the late 70s. We have more business cycles, therefore the numbers are more significant. What we also get in terms of the ISM is real products bought and sold. So ISM manufacturing is widgets in a warehouse that are sold as product. With the service sector, a service can actually be a contract just between two people. So this is why we place more importance on manufacturing. We'll look first at the ISM services number, and you treat this number in exactly the same way as you treat the ISM manufacturing number. We'll look at that, and then we're going to move on to consumers. So economy is made up of businesses and consumers, and at the moment we're staying within businesses, so manufacturing and services. And then we're going to move on to consumers. So try to pick up, again, in the bigger picture, why we're looking at these things. They're leading indicators, they lead GDP, and we use the stock market to make and take positions based on our view of the United States and the world. So at some point in the future, we're either correct or we're wrong, but we're hoping always to be correct. Well, at least 75% of the time. Okay, so let's move on to the next video, and I'll see you on the other side.